Welcome to Mortgage Financing, Guiding Client Conversations. How confident are you tackling the subject of mortgages with homebuyers? How much should you explain when it comes to residential mortgages? What should you do to help your buyer clients secure financing for their home purchase? As a real estate representative, you can add value to a buyer client's experience by protecting and promoting their best interests when it comes to discussing mortgages and their impact on the trade. The first part of this course tells you what you need to know about your role, responsibilities, and legal requirements when discussing mortgages with buyer clients. In the second part, you'll use your skills, knowledge, and experience as a real estate representative to respond to challenging mortgage scenarios. Let's begin. RECO gratefully acknowledges the following external subject matter experts from the Ontario real estate and mortgage industry for sharing their time and expertise in the development of this course. Thank you for your valuable contributions. The first 3 units of this course review your role and responsibilities when discussing mortgages with residential buyer clients, including professional conduct and legal requirements. This course will not deal with commercial mortgages. The last 2 units focus on mortgage scenarios you are likely to encounter in real estate trades. Click Next to begin Unit 1.
To receive credit for completing this course, you must complete all units of this course in the order presented. After successful completion, you will be required to declare that you are the registrant who personally navigated through and completed the course. You will not be recorded as having completed this course and cannot apply completion towards your mandatory continuing education requirements for registration renewal or reinstatement until you complete your declaration. Remember, once you have met your mandatory continuing education requirements, you will be required to submit an application to renew or reinstate your registration to RECO and pay the corresponding application fee. Once you have met your MCE requirements, you must submit an application to renew or reinstate your registration to RECO and pay the corresponding application fee. After you pay the application fee, you can access your MCE courses at any time during your registration cycle. While RECO sends out courtesy reminder emails 60 days prior to your registration renewal date, you can complete your MCE courses at any time. You do not have to wait until you receive the 60-day reminder email. The content of this course is for background educational purposes only. It is not intended as a substitute or basis for creating or communicating a professional opinion, nor is it intended to replace professional advice regarding any topic or legislation referenced here. For professional advice and support regarding any topics referenced in this course, please contact a qualified subject area professional. Select the Disclaimers tab to review the course disclaimers.
This is Unit 1, Mortgages and Real Estate Trading. In this unit, you will review the connection between mortgages and trades, identify information and resources to share with clients, identify mortgage risks for consumers and registrants. For most consumers, buying a home is the single biggest purchase of their lives. As a result, most buyers will need to secure financing in the form of a mortgage to buy real estate. Paying off this loan will be the buyer's responsibility for years, if not decades to come, because mortgages appear as a charge on the title of the property, remaining there until the property is fully paid off. For these reasons, Mortgages play a crucial role in the real estate trade. Why is this important for you and your business? Well, RECO routinely receives consumer complaints about registrants overstepping boundaries as a result of the steps they take and the decisions they make in the trade regarding or involving the client's financing. You are the trusted advisor that clients look to for guidance and support on all aspects of the trade, mortgages being one of the most crucial ones. This course will help you maintain boundaries while providing you with direction on how to guide and support client conversations on mortgages in a compliant way. Let's review some statistics that highlight the critical role mortgages play in real estate purchases. Click any button to begin. A July 2018 report by Mortgage Professionals Canada on the housing and mortgage market revealed the following consumer attitudes towards home ownership. Click each icon to learn more. Consumers were less likely to classify mortgage as good debt in 2018 as compared with the past several years. Close to 75% of Canadians aged 25 to 34 who do not currently own a home are very interested in buying one within the next 5 years. Canadians aged 25 to 34 who do not currently own a home state a lack of financial preparedness as the main reason for not owning property. Let's review some statistics that highlight the critical role mortgages play in real estate purchases. Click any button to begin. Consumer surveys from 2017 and 2018 by the Canada Mortgage and Housing Corporation, or CMHC, revealed the following consumer attitudes around mortgages. Click each icon to learn more. Almost 40% of buyers expressed concerns and uncertainty during the buying process. Areas of concern included unforeseen costs, paying too much for a property, finding the right home, interest rate increases, and qualifying for a mortgage. Only about half of buyers were aware of the latest mortgage qualification changes, meaning that close to half were not. Most buyers consult with a real estate representative on mortgage advice. Let's review some statistics that highlight the critical. A recent Equifax Canada survey revealed the following consumer attitudes around mortgage fraud. Click each icon to learn more. 13% of Canadians felt it was okay to lie a little and embellish a mortgage application. 16% of those surveyed believe mortgage fraud is a victimless crime. 8% admitted to misrepresenting the facts on a credit or loan application. Let's review some statistics that highlight. What do these numbers mean? Well, it means that affordability is a big consumer concern. People worry about getting a mortgage and the impact it will have, not just on the purchase itself, but also on their short, medium, and long-term financial affairs. Also, It means that a considerable number of consumers see mortgage fraud as a victimless crime and justify lying on a mortgage application in order to buy a home. Knowledge is an important part of consumer protection, and these statistics tell us that close to half of consumers are not familiar with current mortgage rules. Most consumers will come to you as their real estate representative to fill these knowledge gaps and get mortgage advice. This places you in a delicate position of trusted advisor on real estate financing. So, can you be a trusted advisor on mortgages? What can and can't you say and do when it comes to mortgages? Before we answer that, test your knowledge of the mortgage landscape in Ontario. Select the best response for each of the following questions about mortgages in Ontario. You will have an opportunity to see how you did and review the correct answers at the end. Who regulates mortgages in Ontario? Select the best response and click Submit. Does FSRA, the mortgage regulator, have authority over real estate registrants? Select the best response and click Submit. What is the difference between mortgage specialists or loan officers at a lender and licensed mortgage brokers or agents? Read each statement and select the best response for each individual. Click Submit once you've made all your selections. True or false? A pre-approval or pre-qualification is the best way to guarantee buyer financing. Select one option and click Submit. Who can provide mortgages in Ontario? Select all that apply and click Submit. On screen are your results. Review the correct responses for the assessment you've just completed by clicking the Next button. Mortgages are subject to federal or provincial regulations. FSRA is the provincial regulator, and OSFI is the federal regulator. In Ontario, banks, credit unions, trust companies, insurance companies, and a variety of alternative lenders, including private lenders, can all provide mortgage loans. To secure a mortgage loan, your clients will usually speak with mortgage professionals or loan officers at a lender, or with licensed mortgage brokers or agents. They have different levels of accountability and typically offer different loan options. While a mortgage pre-qualification or pre-approval is a great first step, it is not a final commitment from the lender. REBA requires you to do everything you can to provide the highest level of service in promoting your clients' interests. Providing guidance and opinions on matters you are informed, qualified, and authorized to speak on is one way to do this. This includes general mortgage information, like highlighting different types of lenders, current mortgage rules, recommendations on inserting, fulfilling, and waiving financing conditions in an offer, and providing general information of how the mortgage process intersects with different stages of the transaction. But you must also recognize when specific mortgage information falls beyond your expertise and qualifications. It is then when you must urge your clients to seek expert help from a mortgage professional or loan officer at a financial institution or a licensed mortgage broker or agent. The mortgage industry regulator in Ontario prohibits trading or dealing in mortgages without a license unless an exemption applies. This means that, unless you are also licensed by the mortgage brokering regulator, there are things you cannot do or say when it comes to mortgages. So, what can you say or do to protect a client's best interests when it comes to mortgage advice without stepping outside your boundaries? Select the statements that can apply to each individual and click Submit. The check marks on screen highlight some steps that real estate registrants and licensed mortgage brokers can take to support consumers. Click Continue to learn more. Let's review more of what you, as a real estate registrant, can do to support your clients when discussing mortgages, in contrast with what a mortgage broker can do. As a real estate registrant, you can provide diligent service and support to consumers, share information and resources from reputable sources to help inform a client's decision, know and explain the highlights of mortgages in general terms. Know and explain how the mortgage process works in general terms, from pre-qualification or pre-approval to managing financing conditions in an offer to the lender's final commitment. Always be mindful of offering definitive advice because it's quite easy to move from a gray area to a problem area. Do not cross the line into the following actions only licensed mortgage brokers or agents can take. Only licensed mortgage brokers or agents are authorized to help consumers fill out a mortgage application, promote themselves as mortgage experts, negotiate a mortgage with a lender on behalf of clients, gather documents to submit for a mortgage application. As a real estate registrant, you can only advise clients on the types of documents that are normally required by a lender, provide advice on the suitability of different options, the terms or conditions of various mortgages. As a real estate registrant, you can only provide general information and urge clients to seek expert advice. Click the link to learn more about mortgage brokers and agents. What is the main difference between mortgage brokers and mortgage agents? Both are licensed by FSRA, the mortgage brokering regulator in Ontario. Mortgage brokers are required to have a minimum of 2 years of work experience and must have taken and passed an approved mortgage broker course. Mortgage agents can perform the same tasks as a mortgage broker, but they must work under the supervision of a mortgage broker. Understanding risk is an important part of your client's informed decisions. But should you have a conversation on mortgage risk? Yes. Talking to your client about risk is always a great idea, as long as you let clients know that they will need the additional input of an expert who can offer more than just the highlights you can provide. Mortgages involve a lot of money and complex legal documents outlining a long-term commitment. The potential for misunderstanding loan terms or underestimating the financial obligation is huge. For consumers, the consequences of a lack of knowledge in the mortgage process and the commitment it brings to their lives can include losing thousands of dollars in trade deposits if financing is not secured before the deal closes. Deals that don't close, a burdensome mortgage they will struggle to pay in the future, and the risk of default and bankruptcy. If your buyer overstretches financially and can't really afford the home they purchase, the risk of becoming house poor is another likely outcome. They may not afford to do anything else after paying a mortgage and basic bills, which can mean anything from not being able to go out to dinner, take a vacation, or even pay for necessary car repairs. They may fall into the trap of relying heavily on credit to stay afloat, accumulating even more debt that they will struggle to pay back. Buyers who do not easily qualify for financing may also be tempted to go along with mortgage fraud to mislead a lender to approve a mortgage. Mortgage fraud is a crime, and it is a risk consumers and professionals should avoid at all times. Besides the risk for consumers, mortgages play an important role in your own compliance risk. For example, your clients fail to secure financing after you advise them to forego financing conditions in the offer to make it more competitive. They will lose their deposits and the trade may not close. You did not protect their interests, and your actions have caused them harm. You could be the subject of a mortgage-related complaint, lawsuit, or other action taken against you. All of these outcomes are possible as a result of your failure to protect your client's interests. Remember, clients are in a vulnerable position and will look to you for guidance and support. When you fail to provide the best level of service possible and do not take steps to protect their interests, you open up the door to a number of negative outcomes. Negative outcomes include fines, penalties, or other disciplinary action taken against you by RECO. Depending on the severity of the complaint, RECO could even revoke, suspend, or refuse to renew your registration. You could also face outcomes from non-compliance with other laws that impose requirements on the steps you must take during the trade, such as the requirements under FinTrack to confirm identity, keep records, and report suspicious transactions. This is separate from any disciplinary action taken by your real estate board or association. You can access resources to review RECO's discipline paths and outcomes. Besides disciplinary action taken by RECO, other regulators, entities, or even your own board, you may also face mortgage-related lawsuits from consumers. This may result in you opening an insurance claim with your insurer. Historically, mortgage-related issues have been one of the top cause for insurance claims to be made under the errors and omissions coverage of the Professional Liability Insurance Program administered by RECO. Many of these claims tend to evolve around the removing of two conditions in the offer: securing financing or the sale of the buyer's property. Common errors include not documenting the disclosure to the buyer of the possible downsides of waiving these conditions and being too casual about the ability of clients to get financing. Ensure to always keep your paperwork in order. Remember, the real estate market is unpredictable. A drop in the value of a property between signing the agreement of purchase and sale and closing may result in your client not being approved for financing. So, without a financing condition, your client may be exposed to significant risk. It's important to note that you can't completely avoid claims made against you. They may happen regardless of whether you are at fault or not. It's possible that at some point in your professional life, a mortgage-related error or omission could result in legal action against you. So take steps to mitigate your own risk. The provincial mortgage regulator may also receive consumer complaints about real estate registrants for mortgage-related issues, namely for the mortgage advice they provide or for overstepping their role. This means that another regulator could also take action against you. Also, if you participate or encourage others to participate in mortgage fraud, you may face charges under the criminal code. This will be in addition to any actions taken by RECO for violating REBA regulations on fraud. Consider the many potential outcomes of misconduct around mortgages. Any of these outcomes represent significant business risk, including loss of reputation, loss of registration, loss of income, and loss of employment. Understand your own risk and know enough to be able to explain mortgage risk to your clients, in general terms, of course. All mortgages carry a certain risk, but consumers should know that some types of mortgages may be riskier than others. For example, underwriting criteria for alternative lenders often differ from that of major lenders. This means that alternative lenders often weigh the loan decision differently and will place different emphasis on the borrower's ability to repay the loan and their creditworthiness versus the real estate property itself. Another example of mortgage risk is that mortgages offered by alternative or private lenders could have higher interest rates, penalties for repayment or renewal, such as fees upon renewal, or other restrictions. You should always urge your clients to seek advice from at least 3 mortgage professionals to weigh financing options carefully. You can access a great resource from the mortgage regulator on the risks of getting a mortgage. The resources. You should be able to explain to your clients the basics of different types of lenders in order to highlight potential risk. For example, explaining the basics of alternative lenders in general terms is a great idea because they are often the only option available to certain buyers. For these clients, it is important to know that these mortgages may have riskier terms and conditions. Urge your clients to consult with at least 3 mortgage specialists to weigh options provided by alternative lenders. Move the house to the right to learn more about alternative lenders. An example of an alternative lender is a mortgage investment corporation, or MIC. MICs are unregulated lenders who provide mortgages to consumers. You can access additional resources and reference materials. Seeing the resources. Private lenders are a type of alternative lender. They can be private companies or wealthy individuals investing in the housing market. In Ontario, private lenders must be licensed by the mortgage regulator unless they use a licensed mortgage broker. Underwriting criteria for alternative lenders often differ from that of major lenders. Normally, they will weigh the decision to lend differently than major lenders, placing different emphasis on the borrower's ability to repay the loan and their creditworthiness versus the real estate property itself. So, can you be a trusted advisor when it comes to mortgages? Let's summarize what you can say or do when it comes to providing information on mortgages. You can provide diligent service and support by sharing information and resources from reputable sources to help inform a client's decision. Knowing and explaining how the mortgage process works in general terms, from pre-qualification or pre-approval to managing financing conditions in an offer to the lender's final commitment. Urging your clients to insert financing conditions in an offer. Knowing when and how to fulfill and waive conditions appropriately. For this, you must know how lenders assess not just the borrower's ability to repay the loan and their creditworthiness, that is, the covenant, but also the property. But you must also keep in mind that specific mortgage advice will fall beyond your expertise and accreditations. Never misrepresent your expertise in mortgages unless you are also licensed as a mortgage broker or agent. Urge consumers to seek expert help from a mortgage professional at a financial institution or a licensed mortgage broker or agent. Remember, unless you are a licensed mortgage broker, you cannot help clients fill out a mortgage application, promote yourself as a mortgage expert, negotiate a mortgage with a lender on behalf of clients, gather documents to submit for a mortgage application, provide definitive advice on the best type, terms, or conditions of a mortgage. Do anything else that only a licensed mortgage broker is allowed to do. We have prepared a job aid for your reference. You can access resources to review it. This is the end of Unit 1. In this unit, you reviewed the connection between mortgages and trades, starting with statistics on consumer attitudes towards home buying, affordability, and mortgage fraud. You also learned about steps you can take and cannot take to help promote your clients' interests on mortgages. You learned about valuable resources you can share with your clients to help inform their decisions on mortgage financing. Finally, you reviewed important topics in mortgage risk for consumers and registrants. When ready, proceed to the next unit. Welcome to Unit 2, Mortgage Industry Regulations. In this unit, you will learn about how the mortgage industry is regulated in Ontario. Just as REBA prohibits anyone in Ontario from trading in real estate unless they are registered with RECO, the Mortgage Brokers, Lenders and Administrators Act, MBLAA, prohibits anyone from trading or dealing in mortgages in Ontario unless licensed or exempted. Federally, laws such as the Bank Act, Insurance Companies Act, and regulations from the Office of the Superintendent of Financial Institutions, OSFI, oversee federally regulated financial institutions. This includes all banks in Canada and all federally incorporated or registered trust and loan companies, insurance companies, cooperative credit associations, fraternal benefit societies, and private pension plans. Click the items on screen to learn more about mortgage industry regulation. Are there any lenders who are not regulated? Yes, there are several mortgage lenders that are quasi-regulated and unregulated. Mortgage finance corporations are quasi-regulated. Mortgage investment corporations, MICs, and other lenders are unregulated. You can access additional resources and reference materials, seeing the resources to learn more. Just as REBA prohibits anyone in Ontario from trading in real estate unless click the items on screen to learn more about mortgage industry regulation. What is the breakdown of mortgages by type of lender? On screen are some statistics. Just as REBA prohibits, click the items on screen to learn more about mortgage industry regulation. There are 4 designations: mortgage brokerage and mortgage administrator for businesses, and mortgage broker and mortgage agent for individuals. Licensees are accountable to the provincial mortgage regulator. You can access additional resources and reference materials, seeing the resources to learn more. Who can provide mortgage advice in Ontario? Besides licensed mortgage brokers or agents, mortgage specialists or loan officers employed by federally regulated financial institutions, such as banks, can also provide mortgage advice. While the MBLAA does not regulate registrants, it applies to anyone dealing in mortgages and restricts what you can do or say when it comes to mortgages, starting with the prohibition on trading or dealing in mortgages unless licensed or exempt. As stated previously, the provincial mortgage regulator could take action against you if you are doing anything considered trading without a license. This could be, for example, promoting yourself in ads as a mortgage expert or broker with a business card that states mortgage specialist or first-time home buyer specialist under your name. This is also a breach of REBA, which prohibits the use of confusing or misleading terms. False, misleading, or deceptive advertising may wrongly lead consumers into thinking you're an expert or that you hold special designations or accreditations when in fact you don't. The MBLAA also restricts you from doing things like assessing a client's finances to determine which mortgage is best for them, helping clients fill in mortgage applications, or negotiating with a lender on their behalf. Take a moment to review the actions only a licensed mortgage broker or agent can take. Mortgage brokers are licensed professionals who look at your finances to determine the right type of mortgage for you. Mortgage brokers assess and compare the proposed mortgages and determine if you meet the lender's criteria. Mortgage brokers gather whatever information and documents are needed. They make sure all the paperwork is complete and submitted for the lender to approve. They can also explain the features and risks of the mortgage and answer any questions. Mortgage brokers review the rate, terms, and conditions of the mortgage and negotiate with the lender. And they liaise with lenders on behalf of clients during the closing process. REBA requires written disclosure of a number of facts impacting the client and the trade. Keep detailed records of all communications and disclosure for every trade as part of your diligence and compliance efforts. Your clients should also know that, similar to the disclosure you provide to them, the mortgage regulator requires its licensees to provide disclosure to their clients on referral fees and maintain detailed records on referrals provided to real estate registrants. Clients should also understand what to expect when working with different types of mortgage professionals. In simple terms, a licensed mortgage broker or agent may offer a variety of options from different loan providers, while mortgage specialists or loan officers employed by a financial institution will limit their advice to the lender's own products. Levels of accountability also differ, depending on who regulates these professionals. You can access resources to view a compliance checklist you can share with clients who opt to work with a licensed mortgage broker. This will help them know what to expect if they choose to work with one. RECO encourages you to pursue professional development opportunities to increase your competency and expertise. This includes other professional accreditations or designations that will enhance your services and business. Accreditations or designations are tools that set you apart from others and help you provide a higher level of service to your clients. So, what happens if you are registered with RECO and also licensed by the provincial mortgage regulator? In these cases, you must have a clear understanding of the boundaries of each role. Do not blur or cross the line marking the boundary of each of your roles. At all times, fulfill compliance requirements of all applicable legislation. For example, when advertising, ensure your ads are compliant with all laws and that they are in no way false, misleading, or deceptive. RECO requires disclosure of any registration, license, or employment in any other business, occupation, or profession. This could be, for example, disclosing the fact that you are also employed as a teacher or that you hold a designation as a professional appraiser. The same goes for the provincial mortgage regulator, who will also review your suitability to practice. This is the end of Unit 2. In this unit, you learned about how the mortgage industry is regulated in Ontario, starting with a refresher of provincial and federal regulators. We also briefly reviewed legislation overseen by different regulators, specifically the Mortgage Brokers, Lenders and Administrators Act, or MBLAA. Finally, you learned about different aspects of the mortgage industry your client should know about: referrals, disclosure, accountability, and managing dual accreditation. When ready, proceed to the next unit. Welcome to Unit 3, REBA Requirements. In this unit, you will recall applicable sections of REBA that address the support and information on mortgages you can and cannot provide to consumers. Mortgages are a fact of life for most homebuyers. Mortgages carry some measure of risk for you and your clients. That's also a fact. Take steps to mitigate mortgage-related risk. So, what sort of risk are we talking about? If you recall the first unit of this course, risk for your clients is all about the financial commitments they assume during and after the trade. Risk for them comes in the form of forfeited deposits, failed transactions, the inability to continue paying the mortgage, and becoming house poor. Ultimately, there is a risk of default and bankruptcy. For you, the risk comes from the consequences you and your clients may face when you fail to maintain your boundaries and do not fulfill your obligations as a real estate representative. Harming your client is the first consequence of noncompliance, as the decisions you make in the course of the trade are bound to impact your client immediately and directly. Then come discipline and compliance risks in the form of complaints and lawsuits against you and your brokerage. And finally, there's business risk. Success in the real estate business is built on lifelong relationships. The service and support you provide today will shape your client's finances for years, if not decades. If you are not doing a good job in protecting the client's interests, it will cast a shadow on your business reputation. For both you and your clients, there is also the risk of becoming involved in mortgage fraud. This can mean penalties, fines, prosecution, and even imprisonment. So how do you fulfill your role as a registrant, maintain your boundaries while providing mortgage information, protect yourself and your clients from risk, and remain professional? By being compliant and knowing your obligations. REBA has many general compliance requirements that also apply to the information and support you provide around mortgages. Click Next to begin reviewing your obligations around mortgages. Let's start with the client's best interests. Do your best to protect your client's interests by providing thorough, diligent service. This involves taking steps to determine any material facts that could affect their decision to buy. Normally, this refers to facts that you find out about the property, like structural damage or an easement that you shared with your client. However, it may also apply to information you know about a mortgage product, a lender, or perhaps even the client's own eligibility to secure financing. If you are aware of certain risks, let your clients know. If it can have a serious material impact on their best interests, inform your clients. Don't assume your clients will understand the seriousness of a potential issue. Encourage them to seek expert advice to help them make an informed decision. Click the buttons to review applicable legislation and examples on the client's best interests. Click the buttons to review applicable legislation. Your client is considering a mortgage offered by an alternative lender. You encourage them to speak to at least 3 mortgage specialists to obtain expert advice about options available to them, so they can weigh them carefully before committing. And examples on the client's best interests. You must disclose in writing any financial benefit that you or a relative receive for mortgage-related services provided during the trade. This applies to cash, gifts, or other financial benefits you may obtain directly or indirectly from referring consumers to a mortgage broker or specialist. You must also disclose in writing any agreements you have with others to provide services to your clients. Click the buttons to review applicable legislation and examples. Click the buttons to review applicable legislation and examples. Click the buttons to review Every time you refer clients to your friend, A licensed mortgage broker, she includes you in a draw for an annual cruise and pays you a referral fee. You provide disclosure to your clients in writing at the earliest possible time because it is considered a financial benefit. Applicable legislation and examples. Always provide the highest level of service to clients while maintaining your good judgment. At no point should differentiating yourself from competitors turn into dabbling in mortgage financing. Know the limits of your expertise. If you are not knowledgeable or authorized to provide a particular service, don't. Click the buttons to review applicable legislation and examples. Click the buttons to review applicable. You provide general mortgage information to your clients, but when they ask you for your help shopping around for a mortgage, you suggest a few trusted mortgage professionals and disclose any referral fees you receive from them. This helps your clients understand the details on securing a mortgage that will make a real difference to the decisions they will make during the trade. Legislation and examples. Never make inaccurate representations of any part of the trade or your services. For example, you cannot advertise as a specialist in first-time home buying mortgages. Urge your client to seek expert advice with qualified professionals for any aspect of the trade that falls beyond your own knowledge, skills, or competence. Click the buttons to review applicable legislation and another example. Click the buttons to review You always take care to provide general guidance and information about the commitments involved in a mortgage. You share information and resources with your clients, but you draw the line when clients ask you for help filling in a mortgage application or negotiating with a lender on their behalf. At that point, you urge them to seek expert advice from a specialist. Applicable legislation and another example. Be professional at all times and never participate in anything that may tarnish your reputation or affect your professional standing. Click the buttons to review applicable legislation and an example of professional conduct. Click the buttons to review applicable legislation. Although the market is robust, you always suggest clients include a financing condition in their offer. If they resist and state that they are pre-qualified by a lender, you clarify what the pre-qualification actually means and explain the risks of not closing a trade if financing is not obtained. You also clarify that financing may depend on the lender being satisfied with both the buyer's covenant, T4s, employment and credit history, and the property, an appraisal. You explain that the appraiser ensures that the property meets the lender's criteria. Value, location, characteristics, and many other aspects all play into the final appraised value of a home. This is typically done through an on-site inspection. Some lenders will not require an appraisal, particularly when financing is a small portion of the transaction. You document the conversation, the client's acknowledgement, and any decisions in writing. And an example of professional conduct. RECO expects you to use your best efforts and take any and all steps necessary to prevent error, fraud, or misrepresentation. Ensure the information you give is accurate. Do not misrepresent your understanding of mortgages, lending requirements, or the mortgage application process. Never encourage anyone to falsify documents to mislead a lender into providing a mortgage. This is mortgage fraud, and it is a crime. Mortgage fraud includes fraud for shelter, fraud for profit, or any other fraudulent scheme to buy property, such as for criminal activity. You also have to fulfill requirements from FINTRAC on confirming a client's identity, maintaining client records, and reporting suspicious transactions. Beyond an obligation, fulfilling FINTRAC requirements is another way you can protect yourself and your clients from fraud and criminal activity. Click the buttons to review applicable legislation. Click the buttons to review applicable legislation. Your client has been turned down for financing before, but assures you this time it's different. He has a relative who can arrange the whole thing with fake pay stubs and employment letters. The relative also has a friend at a lender who can approve the mortgage by manipulating the approval requirements. You advise the client about the risks of mortgage fraud and explain it's a crime. You also let them know you will not be working with them under these circumstances. You cannot, as an inducement to buy, lease, or sell a property, promise a client that they or another person will be able to get a mortgage or extension of a mortgage. You are not entitled to make a final decision on financing eligibility. And you should never use your position as a trusted advisor to take advantage of a client's vulnerable position in a trade. Click the buttons to review applicable legislation and examples. Click the buttons to review applicable legislation. Your client's credit ratings are less than stellar. They are hourly paid employees in low-paying occupations. They are not sure if they can afford a condo, but they really want to buy. You assure them that you can get them a mortgage with the lender of last resort. It's a close friend who gives you a lot of points for each deal. If I were you, you add, I'd go for it. They will be overextended, but many of your clients are, and somehow they all find a way to make ends meet. It is forced savings after all. The lender's appraisal required your clients to ask their families for an extra $15,000 in down payment. The interest rate also doubled from the original pre-qualification. 8 months later, your clients are defaulting on the home and declaring bankruptcy. Penniless and defeated, they move back with the wife's parents in their hometown in another province, but not before filing a complaint with RECO against you. Inflation and examples. This is the end of Unit 3, REBA Requirements. In this unit, you recalled applicable sections of the Act and Code that apply to the information and guidance on mortgages that you can and cannot provide to consumers. Namely, you reviewed obligations and examples on protecting the client's best interests, disclosure, competent service, opinions and expertise, professional conduct, fraud and misrepresentations, and inducements, all as they relate to the matter of mortgages in a trade. We have prepared a job aid for your reference. You can access resources to review it. When ready, proceed to the next unit. Welcome to Unit 4, Mortgage Guidance Scenarios. So far in this course, you have reviewed requirements, restrictions, and responsibilities when discussing mortgages with buyers. You will now complete a series of scenarios where you will apply your knowledge, skills, and experience as a real estate representative. You will judge the actions of fictional registrants and provide recommendations on ways to successfully manage some common challenges around providing mortgage-related guidance. All scenarios assume single representation, where the salesperson is exclusively representing the buyer of a residential property as a client. Exercise caution in situations where you represent both parties to the same trade, one a client and one a customer, because your obligations differ widely to each one, and what is often satisfactory to one party may not be in the other's best interests. Click Next to review the scenario. How can you help protect a buyer's best interests when providing referrals to mortgage specialists? Consider this scenario. Anna is a registrant and her clients are young, first-time homebuyers who are keen on looking at condos in their preferred area. They state their budget, but when she asks about financing, they say that they thought she would help them arrange for a mortgage. What should Anna tell her clients about arranging a mortgage? All responses are correct because they are all great initial steps to take with first-time buyer clients who, as a first step, should understand what they qualify for before viewing any properties. Buyers should understand the commitments they acquire in a mortgage. The Canadian Mortgage and Housing Corporation, CMHC, offers many great resources that Anna can review with her clients. Her clients are wise in having a budget, but Anna should advise them to speak to a mortgage professional. This could be a mortgage specialist or loan officer employed by a financial institution, or a mortgage broker or agent. These professionals can explain mortgage types, terms, and options, and can clarify how much the buyers qualify for. They can also highlight any potential issues or restrictions the buyers could face in securing financing. Anna should explain to her clients that the actual mortgage amount they get may be significantly different from their preferred budget. Whether or not this is the case, the clients still need to understand the full costs of home ownership to make an informed decision on how much they are comfortable spending on housing every month. Ideally, it should be at a level that allows them to maintain their lifestyle. You can access resources to view the useful resource you can share with clients on mortgage pre-approval and qualifications. Anna reviews some useful information on the CMHC website with her clients. She also explains the general differences of working with a mortgage specialist at a financial institution versus using a mortgage broker. Her clients ask her for a recommendation. What should Anna do to protect her clients' interests when referring them to mortgage professionals? The best response is the last one. RECO recommends that registrants provide the names of at least 3 trusted professionals and let clients decide who they prefer to work with. Anna should be selective in choosing these individuals. They should be trusted, ethical professionals who are known for upholding the standards of their profession with integrity and protecting the client's interests. Mortgage brokers may pay referral fees to real estate representatives and other professionals involved in a trade. Referral fees are incentives for Anna and the brokerage and must be disclosed to clients in writing at the earliest possible opportunity. Anna has taken some great steps to help her clients by reviewing useful resources on the CMHC website. She also explained the highlights of working with different types of mortgage professionals. When clients ask Anna for referrals, she should provide the names of at least 3 trusted professionals and disclose any referral fees in writing. There are several steps you can take to protect your clients if faced with a similar situation. Fulfill all compliance requirements and follow leading practices when providing referrals to clients. This applies to any interest, financial benefit, or compensation you obtain from others for referrals. This could be cash, a gift, or any other form of direct or indirect financial benefit received by you or someone related to you. Let your clients know that other professionals like mortgage brokers must also legally disclose referral fees they pay to others. Some mortgage brokers provide information on referrals through a mortgage certificate that the client signs as acknowledgement. It can happen during an initial meeting or when signing mortgage documentation after an offer has been accepted. You can be there at this time to support your clients, but never help them fill out mortgage documentation and refrain from providing advice on mortgage specifics. For mortgage brokers as well as real estate representatives, non-compliance with referral requirements can result in fines, license or registration suspension or removal, and other consequences. How likely do you think it is for registrants to be fined or disciplined over referral non-compliance? Consider the case of a registrant who only referred her clients to a longtime friend, assuring them that he was an experienced and trusted professional who would secure them with a mortgage when others would not, a virtual guarantee. The friend, a relatively inexperienced mortgage broker, also gave her a $500 referral fee for every approved referral. RECO investigated after receiving a complaint from the consumer who was unhappy with the registrant's service. Among other identified issues, they were unduly pressured into working with the mortgage broker and suffered financial damages when the financing inexplicably fell through. This was due in part because of the conduct of the recommended broker. The registrant was aware this was a pattern, as something similar had happened recently to another one of her clients. RECO determined that the registrant had behaved unprofessionally, failed to promote her client's best interests, and did not provide conscientious service by pressuring clients to work with this particular broker, not disclosing referral fees, and making a false assurance of securing the mortgage. In addition, she did not follow RECO's practice recommendations of referring clients to 3 professionals. She was sanctioned by RECO for breaching sections 4, 5, 8, and 39 of the Code of Ethics. She had to pay a fine and was ordered to take courses in business ethics. Click Next to review the scenario. How can you protect a buyer's best interests when providing mortgage guidance? Consider this scenario. Ricardo is a diligent, service-oriented salesperson. His clients tried to buy a pre-construction home last year, but were turned down by the builder's lender. One of the spouses is an independent consultant and had an outstanding court judgment against her. They told Ricardo that it would take some time to get all the paperwork in order and that they'd reconnect in a few months once everything was sorted out. Fast forward to the present, and the buyers are now interested in a resale home of around $700,000, as it would require a lower down payment than a new build. Ricardo agrees, adding that, according to current mortgage rules, buyers of resale homes are approved with a 5% down. This is only partially true. At the time of this trade, the minimum down payment requirement for homes requiring insurance was 5% for homes under $500,000. Any amount between $500,000 and $1 million required a 10% down payment. They tell Ricardo they've been pre-approved by a financial institution for $700,000, and they have a $35,000 down payment for a full purchase price of around $735,000. Ricardo recommends that they see homes well within their price range, and they submit an unconditional offer for a property listed for $705,000. They offer a $20,000 deposit upon acceptance. Ricardo urges them to include a financing condition, but backs down after the clients confirm that they were already pre-approved. After all, the offer is below their maximum limit. The offer is accepted, but after a couple of days, the buyers stop responding to Ricardo's calls and emails. They contact him in a panic a few days later to let him know they have no financing for the property and don't know what to do. They state that their only option is to get the financing he had promised, the one for 5%. Ricardo is baffled and does not know what to do. What did Ricardo do well in this scenario? The best responses are the first two options. Ricardo proceeded with caution by showing the client's properties well within their stated budget. He also advised them to submit an offer conditional on financing. Now, let's weigh in on Ricardo's missteps when providing mortgage guidance. Ricardo made several mistakes when providing mortgage guidance to these clients. Ricardo should have insisted they get the mortgage pre-approval in writing. This is particularly important because the offer he submitted on their behalf was unconditional. He should have also cautioned them that even a pre-approval is no guarantee of financing. Ricardo must be careful when providing information on mortgages, as even information that is generally accurate and sound could easily mislead a client and create issues for all parties. Ricardo's comment that buyers of resale homes are approved with a 5% down is problematic for the following reasons. First, it was incorrect. Mortgage rules at the time of this trade required a 5% down payment for homes under $500,000 and 10% down payment on the amount between $500,000 and $1 million. If the sale price was $705,000, a down payment of $25,000 or 5% was required on the first $500,000, and a down payment of 10% was required on the remaining $205,000 or $20,500. The total down payment required was $45,500, far above the $35,000 the client stated they had. Resale homes may require a lower down payment than a new build, but the exact down payment amount as a percentage of total sale price required by a lender will depend on many factors. The buyer's creditworthiness and the lender's guidelines are just two of them. Also, Ricardo's comment resulted in a misunderstanding that he was going to secure the client's financing at 5% interest. His statement also falls short of conveying the full picture. Providing a 5% or even a 10% down payment on a mortgage means that mortgage insurance will be added to the cost of the property. This applies to any mortgage with a loan-to-value ratio of over 80%. It means that the clients will be paying many thousands of dollars over the final sale price. Ricardo also failed to explain all the risks of not completing the purchase, such as the loss of their deposit or lawsuits from the parties to the failed trade. While it seems the clients in this scenario decided to forego conditions despite Ricardo's guidance, Ricardo should have maintained records of all conversations and client decisions. In case of a complaint or claim, these notes will serve to prove his diligence in the trade. What are the potential outcomes of this scenario? All responses are correct. There are several potential outcomes for all parties in this scenario. The sellers could sue Ricardo and his brokerage, as well as Ricardo's clients, the buyers, over the failed transaction. Ricardo could face disciplinary action from RECO and his own real estate board or association, if applicable, for a complaint filed against him by any of the parties. This could result in a warning, a fine, or other penalty imposed on Ricardo. The buyers could lose their deposit and be sued by the seller and the seller's brokerage for failure to fulfill the agreement. In cases where parties cannot agree on dispersing a deposit, it becomes a legal matter. The courts, not RECO, would have to decide how the deposit would be distributed. RECO also does not reimburse any party to the trade, such as the seller or buyer, for any losses for a failed trade. Ricardo took some great steps to ensure his clients were searching for properties well within their budget and by advising them to submit an offer conditional on financing. However, Ricardo should have paid attention to the red flags raised by these clients based on his own experience with them and the information they had shared with him, such as the problems financing the new build, a past judgment, and the spouse's self-employment. Everyone deserves a fair chance to put their financial affairs in order, but if a client has faced financial or legal difficulties in the past, Ricardo should have been more diligent in ensuring their financing was sound. The same should be done for self-employed clients who may face greater scrutiny from lenders. All of these could signal problems with the client's ability to afford the property. Ricardo failed in his due diligence by not requesting a copy of the pre-approval, particularly because he submitted an offer without a financing condition. This should have been the trigger point to confirm pre-approval in writing. With the buyer's approval, Ricardo could have confirmed financing directly with the lender. Take steps to help your clients by having a basic understanding of a lender's assessment of the buyer's employment, credit history, covenant, and the property itself. However, remember that unless qualified, you should not complete credit checks, mortgage qualifications, or appraisals. The client must also consent because there are privacy concerns involved in these inquiries. Advising clients to consult with a mortgage professional. If clients ask for referrals, provide the names of 3 professionals, disclose any referral fees, and let clients decide who they prefer to work with. Urging clients to obtain written mortgage pre-approval, or better yet, advising them to obtain mortgage commitment from the lender. This should not be subject to additional confirmation of employment, down payment, or a credit report. Approach your client delicately on this matter, as the client could interpret it as mistrust on your part, clarifying that a pre-approval does not guarantee financing. Even after the offer is accepted, the client is still subject to a credit check and verification of income right up to the moment when the lender issues the letter of commitment. Explaining to your clients that the lender is also likely to complete their own appraisal as part of the final mortgage approval. This can happen shortly before closing. Explaining the risks of submitting an unconditional offer and of not closing the trade. Submitting an offer with appropriate conditions that protects their interests. Never influence a buyer to buy, sell, or lease a property by assuring them that they will get financing or with any other inappropriate representation or promise. This is an inducement and a serious breach of REBA and goes against your professional obligations to your clients. Do you think this is unlikely to happen? Well, in a recent case, the registrant faced an errors and omissions claim because they did not insert a financing condition in an offer for their buyer client without first confirming that the client had secured financing. The registrant's client, the buyer, had only verbally stated their income, deposit, and mortgage pre-approval. The registrant accepted this without confirming the information, even when he was submitting an unconditional offer on their behalf. The client was unable to secure financing and the deal collapsed. The seller successfully sued for the buyer's deposit. The buyer then sued their sales representative to pay for part of the damages as a result of losing their deposit to the seller. Click Next to review the scenario. How can you protect a buyer's best interests when removing conditions in an offer? Consider this scenario. Ling helped her clients buy their first home more than a decade ago during a very competitive market. Now they want to upgrade to a larger property, so she recommends they buy the new home first. When another buyer presents a bully or preemptive offer for their preferred property, she urges them to stand their ground. However, the clients get anxious and insist on removing all conditions. She explains the risks and urges them not to remove the conditions. She also suggests they consult with a lawyer and express serious concerns. She cannot get them to change their minds. She takes notes, summarizes her recommendations, documents the client's decisions in writing, and also obtains their written acknowledgement of all risks. Following her client's instructions, she removes all conditions and submits an unconditional offer at full list price. It is accepted with a 90-day closing period. Immediately, Ling moves to list her client's older home. The clients insist on wanting a high sale price, so she lists it at a price the clients agree with. 60 days and 2 price reductions later, the house has not sold, and most of the visitors' feedback indicates it's overpriced. As the closing day approaches for the new home, the lender appraises the new house at $70,000 less than what they paid. With the new home closing in less than a month and their own home unsold, the clients are cornered and have no financing. They ask Ling to contact the sellers and offer to close the new home at $70,000 below agreed sales price. The sellers refuse to grant the price reduction. The buyers must now come up with the shortfall. Time is ticking away. Ling is extremely worried about her clients. What should she do? Let's begin by highlighting what Ling did well in this scenario. Type your responses. Then, click Submit to compare your answers with ours. Ling proceeded well in urging her clients to stand their ground when a bully or preemptive offer appeared. She was a source of calm and professionalism during stressful and tense negotiations. When her clients suggested removing all conditions, she was diligent in protecting herself and the client's best interests by clearly explaining the risks of an unconditional offer, urging them to reconsider, and actively trying to dissuade them. She also did well in documenting all her clients' decisions and obtaining their acknowledgement for her warnings on risk. Now, let's weigh in on Ling's missteps. Type your responses, then click Submit to compare your answers with ours. Ling may have misjudged the market. Perhaps she set an overly optimistic listing price on the client's home in relation to comparable properties. Perhaps her client's desire for a high sales price overruled her good business sense. Even if this was done with the best intentions in mind, it may have resulted in a lack of offers for the property. Potentially, she missed the market price for the house. She also did not seem to run comparables on the property the clients were to buy, and as a result, they paid too much for the new home, as evidenced by the lender's appraisal. This is where the mortgage-related mistake comes in. She did not take into consideration or explain to her clients that lenders often assess the borrower as well as the property. In this scenario, the lender's appraisal of the property had a domino effect on the trade. There are many factors that impact the appraisal process and lender policies. As a result of the lender's appraisal, financing is now compromised. If the clients cannot come up with the shortfall, they may lose their deposit if they choose not to close. They could also be sued by the seller for damages. In addition, the brokerage could also sue them for commission. Ling's clients are cornered. They have an unconditional accepted offer on the table, but have no financing and face a big shortfall as a result of the appraisal. They ask about mortgage options, in particular, about alternative lenders. What should Ling explain to her clients about alternative lenders? The best response is the last option. Deals that may not close may lead buyers like Ling's clients to consider alternative lenders. Some alternative sources of mortgages include credit unions, mortgage investment corporations, and private lenders. While Ling should not be providing mortgage advice, as an experienced salesperson, she should know the difference between major lenders and alternative lenders to highlight any general risks to her clients. This should be done before they commit to a mortgage with a lender who may potentially have different lending criteria than anticipated. She should also clearly explain the potential consequences of not closing a trade, from lost deposits to lawsuits from the seller for damages and from the brokerage for commission. Ling is there to provide guidance and support, but ultimately, this is the client's decision to make. Ling did well when she urged her clients not to submit an unconditional offer and explained the risks involved when they insisted. She documented the client's decisions and obtained their acknowledgement. She may have set an overly optimistic listing price for the older property and let her client's desire for a high sale price overrule her good business sense. This caused the property to sit unsold on the market at a very crucial time. The lender's appraisal of the new home had a domino effect on the trade. Ling should have clearly understood and explained to her clients that lenders will assess not just the borrower, but the property as well. Faced with a shortfall of $70,000, the clients approached a lender of last resort to salvage the deal, which resulted in significantly higher costs. Take steps to protect your client's interests by knowing the market and acting accordingly, even when that means telling your clients what they don't want to hear. Ensuring they understand the impact of sale price deviations and consider obtaining financing based on a worst-case scenario, no matter what market you're dealing with. Appraisals, for example, are a lender requirement and can disrupt the trade, especially when they take place after conditions have been waived. Determining and managing their expectations, particularly if the clients are buying and selling at the same time. They may not get any offers above list price, or they may not even get the full list price at all, or their property may eventually get full list price, but may take much longer to sell than anticipated. In some cases, it may happen after the closing date of the other home they've just bought, placing them in a difficult position of paying two mortgages at once. Preparing your clients for different outcomes. In this case, it was the appraisal. Life, like real estate, is dynamic and things can change very quickly. The market, a job loss, a family emergency, even an inheritance or monetary gift that does not materialize. Work on the assumption that things can change in preparation for the time when they do. Do you think it is unlikely that someone like Ling would make these mistakes? There's a case where a registrant urged her clients to submit an unconditional offer in order to outbid other buyers, without explaining the potential consequences of that decision. When the buyer's home failed to sell before closing on the new property, they were left with a massive shortfall in financing. Unable to agree on a price reduction with the sellers of the new home, the deal collapsed. The sellers eventually sold the home to someone else for much less and sued the buyers for the difference, plus forfeiture of their deposit, costs, and interest. The buyers sued their representative to pay for some or all of the damages they suffered. Damages for this case may include the potential loss of the buyer's deposit, an additional amount for the registrant's negligence over failing to sell their home, plus punitive and aggravated damages. Punitive damages are imposed to deter someone from behaving in a certain way again, and aggravated damages refer to the harm suffered by the party who is suing. In this unit, you completed 3 scenarios on providing guidance and information on mortgages. These scenarios tested your knowledge of compliance and leading practices when providing referrals to mortgage professionals and when inserting and waiving financing conditions in an offer. We have prepared a job aid for your reference. You can access resources to review it. When ready, proceed to the next unit. Welcome to Unit 5, Mortgage Fraud Scenarios. In this final unit, you will complete a series of scenarios focusing on mortgage fraud. You will judge the actions of fictional registrants and provide recommendations on ways to successfully manage common challenges on this topic. All scenarios assume single representation, where the salesperson is exclusively representing the buyer of a residential property. Before you begin, let's do a quick review of mortgage fraud. In mortgage fraud, a deliberate misrepresentation is made to mislead a lender into providing a mortgage. This either occurs as a for-profit scheme conducted by fraudsters or as mortgage fraud for shelter committed by buyers who can't qualify for a mortgage based on their income, credit, or down payment. Fraud for shelter is the most common type of mortgage fraud. It refers to any deliberate misrepresentation made to help buyers secure a mortgage. Click to learn more about different aspects of mortgage fraud for shelter. How does fraud for shelter happen? Fraud for shelter normally happens when one or more of the parties use false documents to misrepresent a borrower's income in order to get a mortgage. Mortgage fraud, even if it's done for shelter, is a crime, and its many victims stand to lose a great deal. Click each character to learn more about how mortgage fraud affects different parties. Lenders lose money when debts are not repaid because mortgage fraud increases the risk of mortgage default. Their losses are likely recouped through increased costs and fees passed on to consumers. Consumers, in general, may face higher costs over time because fraud can also lead to increased insurance costs, higher lending rates, inflated real estate prices, and increased costs for enforcement agencies. A borrower involved in mortgage fraud may face losses up front and over the long term. They may wind up with a house they can't afford, struggle to make ends meet, and find themselves making some tough lifestyle sacrifices. They may be at risk for defaulting on their mortgage. Some borrowers may have to declare bankruptcy and face financial wipeout when debts spiral out of control. Default and bankruptcy will affect the borrower's credit rating and financing. It may take years to recover from the impact to both. Borrowers may also be fined and charged for their role in the fraud, a crime. Professionals involved in mortgage fraud stand to be fined, disciplined, and charged for their role in the fraud, a crime. Any individual convicted of violating Sections 34 and 35 of the Act, which deal with furnishing or falsifying information in a trade or encouraging others to do so, would be liable to a fine of not more than $50,000 or imprisonment for a term of not more than 2 years less a day, or both. Mortgage fraud is a criminal act and, as such, criminal charges could be pursued. Finally, registrants are required to act with honesty, integrity, and in accordance with the law. Accordingly, any registrant proven to have knowingly participated in mortgage fraud faces losing their registration under the Act. While mortgage fraud for shelter is the most common type committed, for-profit fraud can also occur. Fraud for profit is a scheme conducted by fraudsters, who often have a team of accomplices to inflate property values, falsify loan documentation, purchase real estate with no intention to reside in it, obtain a mortgage loan, and make off with the money. This fraud is often committed by registrants who are working in collusion with the criminals. In most cases, the fraudster, a straw buyer, a real estate salesperson, a lawyer, and a mortgage professional collaborate to defraud a financial institution for large sums of money. This is how each person participates. The real estate salesperson works for the fraudster. They may list a property for sale significantly over market value shortly after it closes. The lawyer forges mortgage documents and files necessary paperwork. The mortgage broker or loan officer at a financial institution uses fraudulent documents to arrange loans in collusion with the lawyer and salesperson. The straw buyer is essential to the scam and may be very young adults, older adults, very recent newcomers, or even international students who appear on title as buying or refinancing the property. They may not fully understand their role and, in many cases, probably don't intend to commit a crime. They stand to lose money because they are responsible for the mortgage. This could significantly damage their credit history and affect their finances for many years. Fraud-for-profit schemes may involve buying properties for criminal activity. This could be, for example, buying properties to launder money or as a location where other crimes are committed, such as terrorism, human trafficking, drug trafficking, and so on. What are some fraud-for-profit red flags that you can look out for? Trades involving mortgage fraud could include any of the following: a private agreement of purchase and sale, high-ratio mortgages, equity gifts, further deposits, power of attorney, recent activity on title, property that is free and clear with no registered mortgage or loan. Note that the appearance of one or more of these signs does not necessarily mean mortgage fraud is occurring, but it should alert you to greater due diligence on your part. In addition to paying attention to these red flags, protect yourself from becoming involved in fraudulent or criminal schemes by fulfilling all client identification, record keeping, and reporting requirements from REBA, FINTRAC, and other applicable laws. FINTRAC obligations are specifically aimed at identifying individuals or organizations involved in money laundering and terrorist financing, where fraud is often part of the scheme. You can access resources to review FINTRAC obligations and learn more about ways to avoid becoming the victim of mortgage fraud. You're now ready to proceed to the mortgage fraud scenarios. Click Next to review the scenario. How can you protect a buyer's best interests when they may not qualify for a mortgage? Consider this scenario. Jamie's clients have been in the country for less than 2 years, a couple with 2 young children who want to move out of their cramped rental. He personally confirms their identity and employment information to fulfill record-keeping requirements. One spouse is self-employed part-time, with a part-time contract position on the side. The other spouse recently obtained a full-time job after being laid off earlier in the year. Jamie is concerned that their short credit history, along with their employment status, will create problems under the new lending guidelines, but he really wants to help them. What should Jamie do to help his clients? Jamie should provide and review information and resources to his clients on mortgage financing. Beyond that, he must be an active promoter of his clients' interests, providing timely and knowledgeable information and guidance at all stages of the trade, and taking all necessary steps to assist them. He should refer them to at least 3 reputable mortgage professionals he trusts and disclose any referral fees. A licensed mortgage broker or a mortgage specialist at a financial institution can assess their creditworthiness and dispel any myths on mortgage eligibility and requirements. This is particularly important for first-time homebuyers, those who do not understand the mortgage process, or clients whose employment or credit history may lead the lender to assess them as higher risk. The clients will get a clear picture of the challenges ahead and better prepare for the home buying process. If lenders express concerns or deny financing, Jamie may have to suggest his clients delay their purchase until they're in a better position to secure a mortgage. You can access resources to learn more. So how does Jamie handle the situation? Jamie is frank with his clients about his concerns and urges them to delay their purchase, cautioning them that financing may be a big hurdle for them before and after the purchase. They do not want to postpone the purchase because they feel prices will only continue to rise and they will miss out on the opportunity to buy a home. So, he advises them to consult with mortgage professionals and provides 3 referrals. The buyers choose a mortgage broker they like from the names Jamie suggested. The mortgage broker expresses serious doubts about their eligibility to obtain a mortgage from a major lender and suggests they consider alternative lenders. The clients inform Jamie of the broker's advice. Jamie reaches out to a colleague for suggestions. The colleague discreetly tells Jamie that he has a friend who can help his clients qualify with fake employment letters. He even has a contact at a lender who approves the whole thing. She adds that, for many first-time buyers, it's the only way to buy a property these days. What should Jamie do to help his clients? Jamie is free to consider any options to advance his clients' interests. They may not qualify for a mortgage with a major lender, so their options are limited. He can discuss this with his clients, but he should never encourage them to mislead a lender to obtain a mortgage. If he takes one step toward furnishing or falsifying information in a trade, or encouraging others to do so, he will violate several laws, including REBA and potentially the criminal code. Some people may consider the colleague's proposal an innocent way of helping a client. And there are no victims, right? The clients get a lovely family home and the lender gets paid. Well, this is mortgage fraud, and it could get everyone into serious trouble. By enabling clients to secure a mortgage they would otherwise not qualify for, Jamie is failing to protect their interests, participating in fraud, and risking his career. Jamie decides not to pursue his colleague's option. The clients obtain mortgage pre-approval with an alternative lender for $300,000 and have a down payment of $30,000. He searches for properties below their maximum limit and finds a condo unit for sale at $315,000. The clients like it and submit an offer conditional on financing based on Jamie's guidance. The lender, despite having given them a pre-approval, requests a much higher down payment of 20%, which the buyers do not have. With his client's permission, Jamie lets the seller know that the buyers cannot fulfill the conditions because they do not have the full down payment required by the lender. The seller offers Jamie's clients a vendor take-back mortgage if the sale price increases to $350,000. He offers to provide the difference in required down payment and highlights the savings for the buyers who will avoid mortgage insurance. This loan will be in the form of a second mortgage. The seller also asks that the buyers sign a promissory note that will not be registered prior to the deal closing and requests that the arrangement not be disclosed to the lender. What should Jamie highlight to his clients about the seller's proposal? The first and last options are correct. The seller's suggestions will result in a more expensive property because the seller wants a higher sale price. The proposal mostly protects the seller's interests, not the buyer's. Besides higher debt, the buyers may have to deal with higher interest rates or more restrictive terms for both mortgages. Even if they are not paying for mortgage insurance because they are providing a down payment of 20%, the buyers are now assuming more debt and will not save any money. Concealing the second mortgage from the first lender could constitute mortgage fraud. What are some potential consequences if Jamie and his clients agree to the seller's terms? All responses are correct. While each case is different, Jamie could be fined, disciplined, and face other penalties for breaching REBA because the lender's request to conceal the second mortgage may constitute fraud. For Jamie, outcomes could also include a proposal to revoke, suspend, or refuse to renew his registration. All discipline decisions are made public by RECO, which could affect Jamie's career prospects in real estate. He could also be fired from his own brokerage. In addition, Jamie could also be charged with fraud under the criminal code. We don't know how this scenario ends. Jamie took some great steps to protect his clients. He advised them to consult with mortgage professionals and search for options to help them fulfill their dream of home ownership. He also acted wisely in not pursuing his colleague's suggestion to falsify client documentation. At this point, Jamie should have a frank conversation with his clients about the risks involved in the seller's proposal, which is fraud, as well as the risk of assuming heavy financing they may struggle with down the road. If his clients are keen on accepting the seller's proposal, he should seriously consider walking away to avoid participating in fraud. There are times when it may be necessary to remind clients that all options have been exhausted and make a recommendation to delay the purchase until conditions improve. If you were in Jamie's shoes, what would you do about colleagues or other parties who promote shady practices? Protect your clients and yourself from fraud by not turning a blind eye to others who are involved in fraud. Think about this. Are you willing to harm your clients and risk your career and livelihood for one deal? Don't do it. You can protect yourself by fulfilling requirements from REBA and FinTrack to confirm your client's identity. Maintain records and report suspicious transactions, behaviors, or procedures to the appropriate authorities. If you suspect that mortgage fraud may be occurring or that it has occurred, contact RECO Complaints and Enforcement, your local police, and the Canadian Anti-Fraud Centre, CAFC. RECO addresses concerns and complaints about the conduct of brokers, salespersons, and brokerages, and takes appropriate action to protect the public. All other issues or concerns should be brought to the police or CAFC. Take steps to help protect your clients from fraud by having a frank and honest conversation with your clients about things they may rather not hear. The bad news talk about alternative lenders and riskier If you were in Jamie's shoes, what would you do about colleagues or other parties who promote shady practices? Take steps to help protect your clients from fraud by having a frank and honest conversation with your clients about things they may rather not hear. The bad news talk about alternative lenders and riskier products, and quite likely, the idea of delaying the purchase of a home until conditions improve. Understanding all lender options available to clients and the risks involved in assuming different mortgages. Never participating in anything that could be considered fraud. Discouraging clients from considering mortgage fraud as an option to buy a home. Do you want to hear a real-life example involving real estate registrants disciplined by RECO for participating in mortgage fraud? Well, there was a registrant who was ordered to pay a penalty of over $15,000 and take courses in business ethics for their role in mortgage fraud. That case involved, as the scenario you just completed, a vendor take-back mortgage arranged with the intention of misleading a lender. There's another case where a registrant assisted his former college friend to secure a mortgage using fake employment letters. The registrant presented variations of the same letter to several lenders. One of the lenders, suspicious of the documentation, called RECO to submit a complaint. RECO investigated and imposed a 12-month suspension of the salesperson's registration, who was also required to complete a course in ethics. His registration was reinstated after suspension, but only after the registrant agreed to abide by several conditions, among them that he not act as an officer, director, partner, or shareholder of a brokerage for several years. Click Next to review the scenario. How can you protect your clients and yourself from mortgage fraud for profit schemes? Gustav is working with a seller, a new client who approached him through his website last week. The client recently bought a bungalow for his elderly parents. Gustav was not involved in that purchase, but the seller told him he'd closed last week and had changed his mind. Now he wants to sell it quickly. It was listed at $645,000. And he paid $629,000 for the property. Gustav asks why he's not using the same salesperson, and the client explains that he was not represented. He wants Gustav to list the property for $799,000. Although it's significantly over market value, he emphasizes an upgrade to the home's wiring and plumbing done by his cousin, owner of one of the biggest home renovation companies in town. This and the hot market, he argues, is what justifies the price increase. Gustav does not have time to visit the property, so he agrees to the listing and requests the client's identification. The client has no ID on him and will get it to Gustav the next day. When the next day arrives, the client calls Gustav to say that he has found a buyer for the property. There is no mention of the ID. Gustav finds the entire series of events very troubling and is starting to feel uncomfortable with the client, but he's not sure what to do. Although he's an experienced salesperson, he hasn't really encountered a client like this before, one that raises so many suspicions. What is suspicious after all? What are some red flags Gustav should be aware of? There are several glaring red flags Gustav should have noticed. The client's evasive behavior around providing an identity document, the upgrades and inflated listing price, the prompt relisting, and the seller-secured buyer. Gustav must determine all client identities at the earliest possible moment, as required by FinTrack. Beyond a legal obligation, this can also help Gustav in his due diligence as questions on his client's actions arise. Gustav should have verified any upgrades to the wiring and plumbing systems before agreeing to list the home at a higher price, particularly because they seem to have been completed in record time. Not verifying upgrades amounts to misrepresenting the trade and false advertising. While life may change overnight, it's rare for a client to relist a property just days after purchasing it. Gustav should also find out more about the client's overnight buyer. While it may be true that he found someone on his own, Gustav should take steps to identify them properly and find out more about this individual, because they may turn out to be a straw buyer who is paid for their participation in a fraudulent scheme. Despite his suspicions, Gustav is seemingly aloof and going along with the client's odd requests. This could come back to haunt him. Gustav's client asks him to prepare an agreement of purchase and sale, or APS, for $795,000 and provides him with the name of the buyer. The client takes the APS to review it with his lawyer, and surprisingly, he brings it back signed by the buyer. He also witnessed the buyer's signature himself. At this point, Gustav is very worried and regrets agreeing to work with his client. What should Gustav have done differently with the agreement of purchase and sale? The first and second responses are correct. The best thing Gustav could have done before preparing the APS is to verify the seller's and buyer's identity. This may not have changed anything if the buyer was a straw buyer working in collusion with the seller, but every step Gustav can take to further his due diligence can help to deter criminals and document the trade in protection of Gustav's position. He should have also been actively involved in the negotiation instead of just passively providing the APS to the seller. While the seller has a right to review this legally binding document, Gustav should have insisted on meeting the buyer and determining their identity earlier in the offer process. Asking someone else to witness the APS does not address the real issue of having a buyer unseen whose identity has not been verified, particularly considering the seller's actions. Witnessing must also be done at the time of signing. Gustav has a seller client who has been behaving irregularly. Gustav has not confirmed the client's identity, nor has he visited the property personally. He drafted an APS that was signed by a buyer he's never met or confirmed an identity for, and which the seller witnessed before delivering it to Gustav. What could happen as a result of Gustav's omissions? The best responses are the first two options. Gustav could be prosecuted for fraud, fined, and imprisoned for his role in this scheme. The seller and their mystery buyer, as well as any other accomplices they may have, could all face prosecution for fraud. However, this would be the result of their own criminal actions and not due to Gustav's omissions. While it is partially true that the accomplices stand to make money, the straw buyer is also responsible on paper for the mortgage. Beyond the damage to their credit rating, a straw buyer could be subject to legal prosecution just as the seller. So how does this story end? We don't know. In real life, you may never know what's behind the motivations of others involved in the trade. All you can do is remain vigilant and diligent and take any steps necessary to avoid fraud and misrepresentation. Gustav, in his zeal to help his client, has stumbled upon a fraudulent scheme. Gustav should have been more aware of the red flags of fraud. and he should have been actively involved in managing this trade from the very beginning. There were several early warning signs that Gustav was dealing with a client who was likely involved in fraudulent activities, but Gustav kept taking steps to further the trade anyway. As red flags continued to pile up, he could have warned the client that his actions were irregular and canceled the business relationship. He has failed in his professional vigilance up to this point, and his actions may not stand up to the scrutiny of law enforcement. If you were in Gustav's shoes, what would you do about clients and other professionals who are involved in fraud? Protect your clients and yourself by not turning a blind eye to others who are involved in fraud. Think about this. Are you willing to harm your clients and risk your career and livelihood for one deal? Don't do it. Fulfill all identity, record-keeping, and reporting requirements from REBA, FinTrack, and your own brokerage. Report suspicious behaviors or procedures to the appropriate authorities. How can you protect your clients from the risk of fraud-for-profit schemes? In Gustav's case, he couldn't. You can't protect the interests of someone with criminal intentions. If you do, you may be considered an accomplice to fraud, like Gustav. In the eyes of the law, Gustav may be considered to be a party to the fraud because he failed to take steps once concerns settled in, effectively aiding and abetting a crime. Gustav should have spoken up sooner, expressed his concerns, increased his level of scrutiny, and reconsidered his business relationship with his client. Perhaps you don't think it's very common for registrants to become involved in a fraud-for-profit scheme. RECO revoked a salesperson's registration after it was determined she had listed several properties at inflated prices with false, embellished descriptions to support high list prices. She and her accomplices drafted agreements of purchase and sale and forwarded them, along with the inflated listing and fake financial documents, to lenders, where the buyer would apply for a mortgage. Separately, parties would agree to an amendment to the offer, lowering the real purchase price. This amendment was not forwarded to the lender. The lender approved the mortgage for greater than the fair market value or the true sale price of the property, and the salesperson and her accomplices would split the difference. There was another case involving a salesperson who was also an appraiser and completed false appraisals for clients. This led to millions of dollars in mortgages being approved far above the fair market value of the properties he was trading. RECO investigated and refused to renew his registration. In addition, the salesperson was sued by several of the affected parties and was prosecuted criminally for their role in the scheme. As you can see from the scenarios you've just completed, there are many things you can do to protect yourself and your clients from mortgage fraud, be it fraud for shelter or for profit. If your clients can heed this advice, they'll significantly reduce their risk of becoming victims of mortgage fraud. Let's start with your clients. Click the buttons to review steps to take to fulfill your obligation to protect your clients' best interests. Advise your clients never to misrepresent income on a mortgage application. While your clients may really want that house, it puts everyone at risk. Caution your clients never to sign documents that contain blank sections. These sections could be filled in fraudulently after you or your client sign the document. Urge your clients to never accept a fee for having their name appear as a buyer on a transaction. By accepting a fee in exchange for their name and credit, they are essentially becoming a straw buyer and could be stuck with a hefty mortgage and damaged credit. What about protecting yourself from mortgage fraud? Click each button to review different actions you can take. Take fraud seriously. Ontario accounts for almost 72% of fraud in Canada, and yet this province represents only about 40% of the country's total population. No matter whom you represent, confirm who the owner, buyer, or tenant is. Trust your clients, but verify their identity and all their personal information. This helps you fulfill requirements from FinTrack, REBA, and your own brokerage. Know your market. Heated markets are often fraud hubs. Even if this is not the case, people may still struggle to qualify for financing, and bad guys exist everywhere. Manage each trade actively. Know how to quickly research the property's history and learn how to recognize suspicious activity, such as property flips, sales history, and time on the market. Recommend buyers have a home inspection and an appraisal of the property. Does the price match the fair market value? Do renovations match descriptions in the listing? If your clients can't or won't take your advice on avoiding fraudulent practices, consider whether to continue working with them. Any fraudulent actions they commit can involve you, resulting in serious legal, disciplinary, or business consequences, not to mention the damage to your professional reputation. Remember, you can report suspicious behaviors or procedures to the appropriate authorities. RECO addresses concerns and complaints about the conduct of brokers, salespersons, and brokerages, and takes appropriate action to protect the public. All other issues or concerns should be brought to the police or the CAFC. You have now completed the last unit in this course. We have prepared a job aid for your reference. You can access resources to review it. The first 3 units reviewed your role and responsibilities when discussing mortgages with residential buyer clients, including professional conduct and legal requirements. For Units 4 and 5, you applied your skills and experience as a real estate representative to respond to a series of challenging mortgage scenarios. These scenarios tested your knowledge of compliance and leading practices and dealt with mortgage guidance on referrals, financing conditions, and finally, mortgage fraud. You will be able to return to this and any other completed course until your registration has been renewed or reinstated.
Thank you for completing this course. To access additional resources and reference materials relating to these topics, select Resources. Please select Exit to close this unit and proceed to the Mandatory Continuing Education Declaration.